Hi there, this is Charles Kelly. Today I want to talk about buy-to-let mortgages and buy-to-let properties, because I think that higher rates of interest that are going up already will kill the buy-to-let property market because interest rates are soaring. Many people would say that it's killed it already. Let me explain why. Now, before I start, I want to say if you like the content I put out here every week, then please like and share. And I do appreciate those comments. I try to answer the comments. So do like and share, and do stay to the end of my videos, because I always offer you some free training to help you get your finances in order. So let me give you an example of why I think that buy-to-lets are literally destroying the interest rates are destroying the buy-to-let mortgage market. So let's give an example. If you bought or you're buying a property for £500,000, I'm going to keep the maths very simple, okay? £500,000 property, £500,000, which will be a typical property in the London sort of southeast area. Now, obviously, there's cheaper parts of the country. I'm giving this to keep the math simple. Let's say that the rent is $20,000 a year, so that's 4% yield. Yield means it's the return you get on your investment. Now, investors look at yield. They don't look at the pretty things about a property. They look at what is the yield. Just like when you buy a share on the stock market, the investors also look at the dividend. What's the dividend yield? A dividend yield on a share could be 2%. It could be 4, 5, 6, 10%. And then in the stock market, they have the thing called a PE ratio, where they work out the value of a share based on the ratio, the cost of that share in relation to its earnings and its dividends and its yield. We don't really do that in property, but you know, if a PE ratio of a share is far too high, it becomes very expensive. Like some of the shares like Amazon and Apple would have very high PE ratios. However, that's not the only thing they look at. But in property, they look at the yield. So £500,000 property, for 20,000 a year rent, 4% yield, great. You know, that's all very well. But then you're borrowing money, right? So let's say you're borrowing 80% on that. Now, I know at the moment you're probably not going to get 80%, but I want to keep the maths simple for my brain. So you borrow 80%, and you know that would be 400,000. So you would have borrowing then on an 80% mortgage. You're in the past, your payments based on a 2% interest rate would be 8,000 a year. Okay, so on a £400,000 mortgage, if you bought a house for £500,000, got 80%, and your mortgage is at 2%, you're doing interest only, your payments will be 8,000 a year, right? So that leaves you a pretty good profit, right? So you're paying 8,000 a year out, right? And then you've got 12,000 a year left over. That's before costs and estate agent fees and all the rest of it. So that's not a bad deal. 80%, 500,000, 400,000 mortgage, 2% loan, okay, 8,000 a year payments. Great, it's all very well. But now you come to remortgage a couple of years later, then it's gone up to 4%, and that's happened to me in some cases. I've had rates go from 2 to 4%, and on the fixed. So that means now that your mortgage now is going up to 16,000 a year. Okay, so your rent's still 20,000. You might better put it up a little bit, but you know you're paying 16,000 a year, 20,000 a year rent. Oh, then you've got estate agency cost, you've got the odd repairs. So you know you're only just about covering it now. You're not really left with 4,000 in your pocket. That 5%, your payments go up to 20,000 a year. So at that point, you know you're not even break even. Okay, it's in fact you're losing money because you're paying out costs. Okay. But at 6%, your mortgage payments now go up to 24,000 a year, £24,000 a year, £2,000 a month, leaving you with a loss of £4,000. But that's not the whole story, is it? Because, okay, you could have paid off some of that mortgage, maybe you wouldn't have borrowed so much, but look at this, rates are expected to go higher, and they've already reached 6%. A broker the other day was telling me that buy-to-let mortgages for limited companies have already gone over 7%. In fact, he had a deal which was tied up for a client. They were getting a remortgage at 3% fixed. It's taken like 5 or 6 months to complete it. But if they hadn't completed this week, the deal would have gone. and their rate would have then gone up to 7% or a 4% difference, and that was on a big portfolio deal. So you can imagine how these rates are affecting things. In fact, what would the client have done then if he'd missed out on this 3% deal, and I think that the loan was several million, then you're talking serious amounts of money, extra in payments. Maybe it wouldn't have been viable anymore. I don't know. So look at this. I mean, at 8%, which is possible, an interest-only mortgage at 400,000 will cost 32,000 a year. Just work it out. 4 8s are 32,000 a year is quite a lot of money to pay out on a mortgage, right? So you've got to be very careful on these big borrowings. And the BBC said the other day that 200,000 people will have to refinance in the next year. Another person, a councillor in Harrow on TV last night, was saying that 30,000 people in her area are struggling with mortgage payments. So this is before a lot of these rates have gone up, because most people in this country are fixing for 2 and 5 years, or between 2 and 5 years. So you've got to be careful here, right? So I mean, even if you'd only borrowed on that £500,000 property 300,000, your mortgage payment would still be 24,000 based on an 8% deal. So the higher the rates, the less that you can borrow. And in fact, the lenders will not lend on the sort of deals now that you might have been able to get in the past. You might have been able to get a 75% mortgage when the rates were 2 and 3%. But when they're going up to 6%, no, the lenders are, hold on, you can't afford that. The lender wants a buffer between the rent you collect and the perceived rent you collect and the payments. They want it to be something like 1.5, 1.4. So they want a clear buffer there to protect them and you against voids and also the cost of agent fees and that sort of thing. They don't just give you a mortgage based on, well, your mortgage payments are 12,000 a year, so or your rent is 12,000 a year, so we'll give you a mortgage based on 12,000 a year loan repayments. No, they want the mortgage payments to be less, so that when you calculate that mortgage, let's say your mortgage is 8,000, 1.5 times that is 12,000. So then they'll give you a mortgage based on that sort of ratio, on the rent ratio. So they want a buffer. So I'm being a bit confusing here, but they want a clear buffer between what your rent is and what the mortgage payments will be, so that you protect yourself. So a lot of people are going to find that when they need to refinance, they're not going to get it, right? They just won't get it. So it's unlikely that a lender on that sort of deal at 8% would give you more than about 200,000. So, to buy a house for 500,000, you're going to need a £300,000 deposit. Now, I'm just guessing those figures. But in short, a lot of people buying these buy-to-let properties don't have 300,000. Or in the past, they'd say, well, I'm not going to buy one, I'm going to buy three. I'm going to buy 100,000, this 100,000, that 100,000, that. Then they're heavily geared. They're up to their neck in debt. And when rates go up, they are going to be in trouble. So do you see what I mean? You could get one property with if you got £300,000 in your hand from a windfall, from you sold a house or something, and you wanted to buy. A lot of people ask me, should I buy one property or should I buy 2 or 3 and just borrow as much as I can? And borrowing has worked in the past. I wrote a book, Borrow and Grow Rich. Of course it works, but you've got to be careful. And it certainly works when interest rates are low, as they've been for the last 10 years. But is it going to work when interest rates are going up? We've had the financial crisis in the UK. They've got a new chancellor now. They sacked Kwasi Kwarteng. They brought in Jeremy Hunt, and he said he will put up taxes to calm the markets. It's almost like the markets and the IMF and the World Bank and the Bank of England are telling the government what to do. They are not the elected government, but they are telling the government what to do. Kwasi Kwarteng was in the States. They sent him back, and it's almost like he went to the IMF meeting in New York and said, I'm going to stick with my plan, he told journalists. And then they said, well, this is not going to work. It's almost like they've told Liz Truss, get him back over there. We don't want him here. Sack him, get somebody else in who will run things. They call it fiscal responsibility, like put up taxes for people, make people suffer for the damage that these world banks have done, for the central banks have done. I'm going a bit political here, but it does seem a nonsense. But what I'm saying is, in the near future, rates are unlikely to come down. They're more likely to go up at the next Bank of England meeting because inflation is not under control. So it's going to. This is all about financial education. It's about educating yourself financially so that you're prepared for things when they happen, like the recession, like these interest rates going up. And it's not just about going out and buying property. So click on the link below and I'll take you through a free training that will help you get started in financial education and become financially free. Look to become financially free over time. It's not get rich quick, but it is about educating yourself. Look what happened this week. The Bank of England had to bail out the pensions industry. They were in trouble. This is where most people's money is tied up, in the pensions industry. Do you know about this? Do you know why this is? This is about financial education. So click on the link below. And if you're a multi-millionaire, you've got 100 properties, you don't need this, but most people do need this. And in my experience, 80-90% of people don't have a clue what's going on out there. They don't know what's coming or going. They just live day to day. So do click on that link and I'll take you through whether you're thinking about buying a property next year, this year, whatever. Make sure you get the education first. Don't just go rushing out and buy properties. Thanks a lot, and I'll see you again. Click on the link below and I'll see you in that training. Thanks very much.